I'm from Indelible Ventures, a little bit about a background of us. We're a seed stage venture fund focused on tech-enabled B2B products that can scale internationally. We're focused specifically on the Malaysian market, even though we're based out of the US. Well, domiciled in the US, I'm actually here in Malaysia. A little bit of background about myself. I'm the managing partner. I'm also the general partner. Collectively over my career, I've managed over 500 million in assets, worked with some of the largest institutional investors. I've been involved in hundreds of companies across continents, across countries, helping many of them to scale internationally. A very broad range of experience and deal flow. That's just deals that I've worked on. I've had visibility into colleagues' work and many hundreds of companies that I looked at and did not invest in. So today is the last of the series. So we've covered a lot of ground so far. So the topic of today is really talking about employee stock ownership and how you understanding the concepts of it, as well of how to create an equity incentive structure. So today I'm going to try and not get overly technical for two reasons. Actually, a few reasons actually. One, I'm neither a lawyer nor a tax advisor. So none of this should be construed as me giving either tax or legal advice. I have to give that disclaimer because this topic of conversation does kind of veer into some of those areas. And where appropriate, I will probably make disclaimers when I'm talking about some of the concepts a little bit later on as well. And as well, I mean, this is something that's still not heavily adopted in Malaysia. It's still making its way into it, and I can talk about my thoughts on why. But it's quite common when you look at some of the more developed startup ecosystems that employee ownership is a big part of it, and that investors that invest in those markets, there's a lot of rules of thumb in regards to how much they expect allocated for employees. And if you're looking at, eventually raising capital from some of those investors, it's good to know all of this in advance so that you can actually start structuring your cap table, and you can start structuring your ownership and your employee stock programs accordingly, so that it's not something that's done at the very end, but you're kind of signaling to those investors that you're getting on top of it. So I'm gonna start off by going into some of the conceptual components of it, and I think the first aspect is really a bit about understanding the trade-off. Um, and so again, this is not always the circumstance, but a lot of people look at it in regards to, especially in the early days, that there's this trade-off between a market salary and some sort of employee stock ownership program or stock option program. Um, it's not always the case. I mean, a hot market demands certain things, but oftentimes when you're in the very early days, you don't have massive amounts of salary in order to allocate. So if you're trying to attract top tier talent away from that big corporate job and come on and be your VP of sales or something along those sort of lines, you're probably not capable of paying the same salary that that big company is. And so a lot of startups try and balance this by saying, okay, I might not be able to give you that big of a cash package, but I can give you an incentive associated with this equity form of compensation. And so there's a bit of a balancing act that ends up happening between there. That's an aspect that I'm focusing specifically on new hires. But oftentimes, when a startup comes up, you have early employees. You may not have constructed it straight from the beginning that they get ownership, but a lot of founders end up looking at those early employees and allocating them some of this pool of equity that's dedicated to them as well. So there's a few things there, and it's good to understand that there's some rules of thumb around it. I've got a slide on rules of thumb a little bit later, so I'm not going to dig too heavily into trying to highlight specific numbers at this point, but just understanding that the market dynamics in each country and point in time, because markets have a tendency of going through highs and lows in relation to some of the salary expectations, how hot the job market is. All of these different considerations can play into it. So let's shift and talk about the benefits of equity compensation and what is it that ended up making this something that is interesting to use. And I think one aspect is that it aligns the incentives and the value creation. So, from the perspective of an investor, and I'll start off with this, is that when an investor looks at it and sees that not just the founders, because obviously the founders have an alignment of incentive to create value for the equity, that there's that long-term incentive to build value, that value creation incentive. But when you look at seeing a broader segment of the employees having that same incentive, it creates more of an alignment around the team towards those same long-term objectives. And it's intended to create a lot more incentive to stick around, because oftentimes there is a good amount of churn, and having that equity compensation can act as a retention tool as well. From the investor's standpoint, when an investor comes in, an investor is not an operator of a business. Me as an investor, I'm not in the day-to-day operations of the business. So we have what's called like a principal agent problem. And so the company is there operating it. So and they're the ones that are making all of the important decisions on a regular basis. And they're the ones that we rely upon in order to be the value creators that are building that company. And so aligning the incentives is viewed as quite a big positive. The second one, talking about driving entrepreneurial behavior in startups, even if you're not the founder, it's good to have that sort of entrepreneurial mindset amongst your employees, so that they're looking at ways in order to build. And that sort of, when somebody becomes a partial owner, there is frequently a mentality shift that puts more of that entrepreneur sort of mentality into that employee as well. Like, this is kind of repetitive of the incentives and this, but when you look at the employees being able to participate in the upside, there can potentially be a huge upside for employees, even with a small fraction of a percent that's allocated to them. And we've seen that. I mean, I can give you examples out of Silicon Valley, when I'm not sure if anyone here has heard of like the PayPal mafia and those sort of terminology that's tossed around. But the reason why that's tossed around is because a lot of those early employees got stock allocations. That company did extremely well. And so those people became very, very wealthy from that. And so they were able to benefit and participate in the upside of that company. Now, conversely, and some people, again, this is a US example, but you may have heard about MailChimp getting bought by Intuit, and how it's becoming quite contentious because they never gave away stock allocations to the employees. And now, it was messaged that was just not something that's done. And now the employees are quite upset because, being able to participate in a $12 billion sale, even if you're 0.1% of 12 billion, that's a lot of money. So, I mean, it's a positive. It's an incentive. It's a way for employees to participate in the upside. Related to the trade-off that I was talking about before, there's a cash conservation aspect of this. And it's a way in order to play that trade-off so that people can get the upside and be able to participate on that. While, not all companies in their early days are flush with cash, so you're able to maintain and conserve some of that cash flow in lieu of salary, giving these as alternates. And in regards to employee retention, when as I said earlier, when a company just launches, oftentimes they don't have a fully structured equity compensation program, plan, scheme, however you want to phrase it. But when you look at those early employees, there's a lot of knowledge that can get built up by them, and they can end up being quite valuable themselves. And so there's an ability to retain those employees. There's also the aspect of, there's some terms which I'll get into later that kind of tie those employees to you for longer and can be used as a retention tool in order to keep key employees tied with you longer, because if they don't, they may lose out on some of that equity compensation that's been allocated to them. So I'll talk about some of those terms earlier, but these are really the key pieces that make this very beneficial. And so reverting back into talking about the perspective from the investor, first and foremost is that, when you're talking about institutional venture capital firms, generally speaking, they're going to require it. It'll be in almost every single term sheet that you'll see, especially if you're talking about dealing with an international firm that is experienced in multiple markets, because it's just standard at this point in time. It's every single time that I get involved with the company, I'm having conversations around ensuring that they're setting aside a pool of capital for an ESOP, and that's just kind of standard. And again, like that alignment of incentives, the impact on recruitment, all of those sort of like things that we said were the benefits of it. This translates into growth. If you have that alignment of incentive, if you're able to attract better people, if you're able to retain your good people and retain those best people, that all translates into growth for the company. And that's a really important thing, not only for the founders, which the founders should be keen on this as well, even though they're going to take some dilution for it. This translates into growth. So it's one of those things. You're the same way that we're talking about a trade-off between compensation versus equity bonuses, we also have to understand that there's a trade-off between some of the dilution that comes out of creating these pools versus the long-term growth that can be accomplished because you're creating this incentives, because of the impact on recruiting, because of the impact on retention. All of that is intended to translate into more growth for the company. But lastly, there is a cap table impact. As I said, it ends up getting diluted, so forth. In multiple rounds, I'll come in at the seed stage and establish an ESOP pool from the beginning. In an A round or a B round or later rounds, they may look at that pool if it starts decreasing with the dilution, or if it's getting used up because it's been allocated out, it may end up needing to get topped up in later rounds. So just because you set up a pool with, say, 10% today, doesn't necessarily mean that at some later round that an investor is not going to say, let's top it back up to where it's back up to 10% total. Doesn't mean that you're allocating to those same recipients more. It just means that you're allocating more so that you can get new hires, so that you can do all of these other things with it. So let's do a hypothetical example in regards to the value of equity compensation. And so as I mentioned with the example of PayPal and so forth, and there's a ton of examples out there, especially these days when it seems like every day that you pick up the news, there's a new unicorn minted in some part of the world. But if you look at like a hypothetical example within this region and say, the statistic may be a little bit out of date, but say that there's about 200 billion of market cap of startups in this region. Globally, it's significantly different. But if we look at just this region and say hypothetically, let's say that it's 200 billion for the sake of easy numbers. And let's again assume, on the low side, because again, I'll generally put a 10% ESOP on most companies, but say that gets diluted over time. There's a mix of some with higher and lower, let's say 5% on average. That would translate to 10 billion in wealth, not held by the founders, not held by investors, but within those employees. And so that's a big deal. And I think one of the challenges that there's been on greater adoption of this is really revolves around the connecting of the dots of the potential source of wealth creation. And I get that there's a number of different reasons, which I'll come into a little bit later, but we haven't had so many instances of acquisitions. We haven't had so many instances of IPOs. And so we haven't had so many instances of realizations. And what I mean by realizations is like cash events, where if I'm an early employee and I get allocated an ESOP, most times it's very hard in order to get that converted into cash value. A lot of times, because that's waiting for a sale to happen, that's waiting for an IPO, that's waiting for these different liquidity events in order for me as the employee with these ESOPs to actually realize the value and actually be able to now, buy that Lamborghini or whatever my dream of in my wealth could end up being. And so we haven't had so many instances of that, but we're getting that. When you look at like the crop of startups that are within this region, and Malaysia is certainly starting to come in on its own, that there's a lot of companies that are starting to get to that point. We're going to start seeing more of a robust market for ESOPs. There's examples in the US where you can monetize some of these ESOPs that are allocated to you in secondary markets. There's things that have been done in order to help solve some of that liquidity issue. And as those come along, I think this is really going to start changing some of the dynamics. So let me shift and talk about some of the types of equity compensation. And then I can talk about some of the problems and some of the rules of thumb a little bit later on with this. So this is kind of a boring table, but I'm just gonna walk through it. So the first one would be option grants. This is really where like the ESOP name really comes from, because generally speaking, it's the employee stock option plan or program. Some people abbreviate stock ownership program, but I'm gonna talk specifically about option grants. And so basically what the option is, it's the same way, like it's a financial instrument that provides the employee with the right, but not the obligation, the right to buy shares at a certain price over some determined vesting period. And so basically what that means is that, I'm awarding you the ability to buy my shares at a price that I'm setting today. Oftentimes that price that is set, which is called the strike price, I'll get into terms a little bit later, that's generally set well at some nominal value. Some countries have rules to where it has to be set at the near a fair market value at the time of issuance, but I don't believe that actually applies here. Again, not a lawyer, so I have to caveat that. But oftentimes when I've seen them, they're priced at some nominal value, because again, when the employee actually exercises them, they're exercising them in order to take advantage of the upside, that it's not intended to put cash into the bank of the company that's issuing them. So generally they're at some nominal value. and there's a vesting period to where just because you allocated those options doesn't mean the employee gets it today. There's some sort of vesting period to where they have to be earned over time. This is the most common structure amongst ESOP plans that I've seen. They're frequently part of, a senior hire package when you're hiring on a senior employee, that there's some allocation of an option grant to that employee. And oftentimes, you reward some of your early employees with it as well, so that you can thank them for being, with you from the beginning. I think the one of the prime examples, I think, is the story about the secretary of Jack Ma at Alibaba. Is the story that I always hear of in regards to it, how he allocated a very small amount of shares, but obviously that company became quite massive, and those shares that the secretary had turned that person into a multimillionaire simply because of being an employee. So that's the option grant. It's a right and not an obligation. And from my understanding, Malaysia actually has a pretty good tax treatment. Again, not a tax lawyer, but from my understanding, these don't actually get treated as like a cash bonus. So not treated as an ordinary income. A lot of countries do. So it's very important, if you're operating in multiple jurisdictions, that you understand the tax consequences, the implications on either the company side or on the employee side. There's a lot of types of equity compensation that can actually be a bad thing for an employee because of the tax implications. But at least from the option grants, from my understanding, they get treated as capital gains, which currently do not have tax associated with them. The next type that's here is share awards. And this is basically, a very direct way of just simply allocating shares. It's typically done as a bonus instead of cash. So, when you get to that bonus time of year, you're given a share award as opposed to bonuses. That's how I frequently have seen them, but there are other ways that they've been used. And the challenge with this one, I'll tell you from a different country's perspective, is that, if you're dealing in a company that is not very liquid, you have no way of selling the shares today. If you get allocated the share award, you'll likely have to declare that on your taxes. And as I said, in many countries, it gets treated as ordinary income. So imagine that somebody ends up allocating me $50,000 worth of shares as a bonus because I'm senior VP of blah, blah, blah. It's not an actual position, obviously. If I get allocated $50,000 worth of shares as a bonus, I can't sell them, so I don't actually have $50,000. I just have a share certificate. But then I declare my taxes, and now I'm getting taxed, say, 35% on the market value of those. So now I got given these share awards for $50,000, and I'm now going to have to pay like $17,000 in taxes for money and cash that I don't actually have. And so, that's an example of needing to understand the tax implications that are associated with it. Again, that I'm not sure the treatment for taxes here in Malaysia on that. So that's something that you would actually need a proper tax advisor in order to guide you on. But I can tell you that in other countries that I've been in and operated in, that most certainly this can end up having some serious tax complications. If it's a public company and you can easily go sell it in the public market, that's a different story. But if it's illiquid and you can't actually sell it, you can create a serious problem for your employee, and they will not be as happy that they got that what was supposed to be a bonus when they end up finding a penalty. Okay, this next one is an employee stock purchase scheme. So this one's a bit odd because you're basically establishing a scheme. This I see more frequently with publicly listed companies. It's not super common with startups. So I'm going to go quickly through it. You're basically creating a program that enables employees to purchase company shares. Oftentimes, there's like a preset discount to the market value or some mechanism in order to establish the price. And it's generally below market value. And you're just enabling them to, if they choose, in order to take part in it. Not super common with startups, but still something that has been used. The ESOP Trust. So essentially, when you think about the ESOP Trust solves one of the complications of having too many names on the cap table, because all of those ESOPs end up getting held inside of the trust, and the trust holds it on behalf of the employees, and the employees that are allocated are members of the trust. It enables easier proxy voting, so that the trust is voting as one single entity, as opposed to having all of these wide varieties. It also avoids some of the complications of large numbers of persons on a cap table. So there's a way of structuring the trust to where you can still do options underneath the trust. But again, a lot of some of the laws in country to country make some more practical than others, but this one has interesting usage because of not having so many names on the cap table, easier proxy voting, etc. So the restricted stock unit, this next one. So this is a lot like ESOP. So you're basically, your restriction is generally just a vesting schedule, that it's restricted by that. You're basically giving a share allocation with the restriction that it has to be earned over time in order to become unrestricted. Sometimes there's restrictions on transfers and other things that are related to it, but it's a different class of stock so that it can have those restrictions. There's no strike price, so the employee doesn't actually have to purchase them the way that they do with options. But again, this is another one with the tax implications, because you're actually getting the shares as it gets vested. You may end up having tax implications if they get treated as ordinary income. So be conscious of that. Phantom stock is one that a lot of people don't actually are not aware of, and honestly, I am not a big personal fan of them, and so it's a bit weird to explain, because people are like, all right, well, what's phantom stock? It has this strange name to it, but essentially what this is, it's like it's a bonus incentive scheme that links it to the stock's performance. So it enables an employee that gets allocated this phantom stock to take advantage of all the upside that it provides. So, essentially imagine that I'm a company and I issue you 5 shares of phantom stock at today's current value of $100 per share, right? But then 10 years from now, I go public and the offering is at 10,000 per share. And so that 5 shares at $100, it was $500 before, but now that is at a 10,000 share price. And so now my 5 shares are worth 50,000. So how does this actually end up playing out? Well, essentially the company is on the hook to pay that in a cash settlement. So the company is supposed to settle that and pay that employee 50,000 in cash for the compensation and the settlement of the phantom stock. So, it can be easier in some multi-jurisdictional circumstances where some of these other employees, some of these other equity compensation types can be complicated when dealing with people in multiple jurisdictions and so forth. But my personal opinion is that the con can outweigh the pro, which is that it can create a very large debt obligation. I mean, if you're doing a very small amount, I mean, if we're talking about that example where it was 500 and it turned to 50,000, I mean, when you're talking about a company going public, yeah, maybe 50,000 isn't that big of a deal. But then if we say, okay, we did it to 100 employees, okay, well, now we're talking about $5 million that needs to be paid out in cash. So oftentimes, when I have seen these discussed, they'd be linked to some sort of liquidity event, like an acquisition or otherwise. But then it creates difficulty from the employee's perspective of, okay, well, like I may not stay with this company for the rest of my life. So how can I actually take the value of it with me when I've left after year 7 of working at the company? Not super common. Again, the options are probably the most common that I've seen. So talking about some of the challenges with ESOPs in the region. The biggest one is the idea of cash today versus the promise of tomorrow. That whole like trade-off concept that I was mentioning before in the very beginning. Put yourself in the shoes of an employee. When when you're a late 20s, something along those sort of lines, you came out of uni, you finally landed a good job, you're moving up the ranks, and somebody's trying and a startup's trying to solicit you in order to take a leadership role in the company, but you'd have to take a pay cut relative to what that big company can give you, but they'll give you some equity compensation. Now most times, especially for folks around that age range, but even for some older folks, you go back, talk about it with your family, your parents, or whatever. Can you imagine very many like moms and dads having their kid come in after spending all of this money on fancy education and all of that, and say, "Hey, I'm leaving this well-known corporate job to go work for this startup, and I'm going to take a pay cut." But don't worry. I'm taking a pay cut, but they're going to give me equity shares in them that could be super valuable later. And honestly, like in those sort of circumstances, like it's not very surprising that a lot of times, take cash today as opposed to the promise tomorrow. And I think part of what drives the commonness of that sort of perception is that we don't have enough stories we don't have like the PayPal mafia sort of story that happened in Silicon Valley and basically helped fund a lot of the startups and the ecosystem that happened there. We don't have that story in Southeast Asia, really, not yet. I mean, it's starting to get there, but the more that we have those sort of success stories of companies going full cycle on having an exit, having an IPO, seeing employees taking part in it, we'll start seeing people realizing the value proposition of equity compensation. Because again, like theoretically, that graphic that I put up before, market cap of the companies being 200 billion, just 5% of that is 10 billion that would be held amongst in some of the employees. That's a really meaningful sum of money, and that's something that can end up growing. But we need to get those. We need to get those sort of realizations. We need to build the ecosystem a little bit more, but it's getting there. And more of the investors in this region are starting to have that utilize the same rule of thumb. A lot of the folks that I've seen operating in other countries around here do the basically the same as what I do, and say have it included into the term sheets. Another aspect, as I said, Malaysia is actually a little bit easier because of the capital gains treatment, but there are a lot of complicated tax considerations. And so it's one of those things that you really have to figure it out pretty well to make sure that you're utilizing it. But I think that's also just like an ecosystem education, because when you look at some of the markets that use it more commonly, all of that's basically settled to where the moment that you talk to your advisor, they're like, yeah, I do this for every single company, boom, and done. The lack of liquidity, I think I've referenced that, and I've made comments on it already. But that's the aspect of, so I get allocated shares in a company, but then what? They're fully vested. I own them. How do I sell them? How can I actually get cash for these? Oftentimes, obviously startups are an illiquid type of share ownership to have. Until companies get acquired, until we start seeing more IPOs, until we start seeing it like in other markets where they started creating secondary markets for employee shares in order to provide some liquidity. I think it remains a challenge in order to see that trade-off start recognizing the value proposition, because one is recognition of the value proposition, another is the realization of that value proposition, the other side of that coin. So the lack of liquidity is certainly a problem. Unaware of the value because it's not so common, that's something that I've already hit on with the cash today versus promise it tomorrow, the liquidity and so forth. But it's certainly something that needs to get built. And there's also an aspect of like the perception of complexity. So there's more and more companies that are starting to do some of the administrative tools in order to make it easier, because there are some level of complexity in regards to the planning, understanding, creating the system in regards to who gets it and when. A lot of those end up becoming board decisions. So hopefully you get good investors onto your board that can help guide you from their experience of how much to give, who to give it to, what to do with all of the terms. But yeah, all that being said, the pros outweigh the cons when it comes to employee share ownership and using it as a part of the equity compensation, because of that sort of all that linkages of the benefits that I said earlier leading into growth. So just because we have a few challenges today, I think it's very important that the market starts moving towards that, because it aligns the incentives significantly better. So let's talk about a few of the terms. I'm going to mostly use the ESOPs, the option grants, because that's the most common. So the first aspect would be related to the number of shares. That's pretty self-explanatory. It's just how many shares are you awarding. The cliff. This is the time period until vesting begins. And so oftentimes, when you hire somebody on, you want to make sure that they actually stick around for a little while. So generally speaking, there'll be a cliff period of say 1 year or 2 years before that employee starts becoming eligible to start vesting shares and becoming eligible in order to take advantage of it. And that's sort of like a trial period, let's call it, of it, but in these it will end up being called the cliff. The vesting is the period of time that the option grant is like quote earned. How long it takes you to actually earn it out. Most times I see it as evenly split over time. But yeah, this is the length of time that it requires in order to be earned. Once it's earned, it's theirs. If they don't vest it and they leave the company, then they'll likely end up forfeiting it. And the strike price is the price at which as I said, when you exercise the option, you actually have to purchase the shares, generally at a nominal value, and the strike price is what it's called. What that price is, the price at which the shares are purchased. And ultimately, there's an expiration date. Most things expire. Things aren't good for forever. So if you don't use it, you lose it. And that's that. So a few rules of thumb, and this will be the last bit that I cover on this. So hopefully people are queuing up some questions in order to ask. But a few rules of thumb in relation to this. So when talking about, what size of ESOP allocation should I end up having, my viewpoint, especially in early stage company, would be that 10% is really the minimum. I generally have companies allocate 10% as part of the as part of my entry. But I've seen other investors use 20% as the rule of thumb. And that'll end up getting topped up over time. But as a general rule of thumb, you know, it's going to be somewhere in that range. As far as the cliff, as I said, it's at least 1 year of employment to make sure that they actually stick on. Vesting, you know, the general rule of thumb here is that you're going to use a 4-year vesting period. Now, oftentimes I see it as like it evenly invests. So some people will break it down on per quarter over those 4 years. Some will do it on a monthly. I prefer quarterly. Some will even just do it on an annual basis. But that's getting into the rather details. But I generally see it as evenly split over those time intervals. I have seen some companies do it to kind of incentivize longer stay employees, where they'll do 10, 20, what is it, 10, 20, 20, 50, as far as the progression of it. But I oftentimes see it as flat. And lastly, the allocation per employee. I mean, different markets have different norms. It really depends upon how hot the compensation market is. I've seen it oftentimes where it's like 1.5 to 2x what an annual salary is what you look at the market value today. But again, like you know, if you look at a country like India, there's a fairly formulaic way of approaching it there. You know, here it's not as well accepted, so that those same rule of thumbs don't necessarily apply here. And so yeah, it's not as set in stone. And lastly, you know, this is because I've seen it done before. I had to toss this in at the end, is that ESOP is not for the founders to regain shares. This is not something that you create this like 10 to 20% of share pool to simply give it back to yourselves as the founders. You know, I have seen a company that I'm not going to name names, but you know, I have seen the instances where a company ends up creating a big ESOP pool, allocating it to themselves, and then use that as a tool in order to force dilution on the financial investors. Yeah, ESOP is not intended for founders, and oftentimes these days there's covenants against that. So yeah, that wraps up the presentation. Again, I tried not to go too technical because I know it's a relatively new concept, and if I went too detailed into some of the nitty-gritty, it'd probably be a little bit tough. But eager to answer any questions. If anyone wants to reach out to me, my email is here, kevin@indelible.vc.